Everybody, welcome to the morning market briefing. I don't really know where to look when I'm sitting here. I feel like I should look at Logan, but then I'm definitely not looking at the camera. But running solo today, Ben and Tom in a meeting. So you're stuck with the A team today. So congrats. You probably woke up thinking every day is kind of the same. And then you get all-star treatment, like watching Michael Jordan play one-on-one at a youth basketball camp. Happy to be here. It is Thursday, November 17th, 2022. Hope everybody is having a great week, doing well out there. Quick snapshot right now, Dow futures down about 93 basis points, so almost 1%. S&P futures down right around 1%. NASDAQ futures down just a little bit more. Oil down about 1.6%. Crude oil at $84 a barrel. Silver's down, gold down. There's a lot of red, not steep red. Bitcoin down, go figure. They've certainly been in the headlines with all kinds of calamity in the crypto space, but lots to chat about today. We're going to start with the Eurozone CPI. We've obviously been talking so much about inflation through many lenses, and I think sometimes it's easy to get really focused on what's happening in the US, where we have seen some improvement, at least on short-term data points. I don't know that it's necessarily a trend as you look at the CPI data we got last week and PPI earlier this week, but it certainly, at least for 1 month, showed some marked improvement. But inflation is a global issue, and we're continuing to see trouble. We've said it, I think, on this call a couple of times. If things are challenging here in the US as it relates to the economic picture and specifically inflation, it's choppier internationally, and the Eurozone is saying that. Their headline CPI number is continuing to accelerate. It came in at 10.6% on a year-over-year basis, up from 9.9%. The good news, if you were really, really digging deep to find a little kernel of gold in this big pile of mud that is the Eurozone CPI report, the good news would be that the expectation was that it was actually going to accelerate more. The expectation was for it to come in at 10.7. So, it was a little better than expected at 10.6, but I think in the Eurozone, similar to here in the US, the expectation matters, and maybe that's a read through on what people are expecting, certainly, and what could be happening on an anecdotal level. But the more important number by a wide margin, in my opinion, is what is actually happening relative to the prior period. So you saw that acceleration. Did they beat the expectation of 10.7%? Sure. But they came in at 10.6 and the last reading was 9.9. That's not favorable, even if it was expected. Core was up 5% year over year, which was exactly in line with where they were for the last month reading for September data, exactly in line with the expectation. So hard to call this anything other than just a really, really high inflation print. We will hear from Christine Lagarde tomorrow morning. I'll make sure Ben gets up to watch that. It's at 3:30 a.m. our time, but we'll definitely have some notes and be able to discuss that to a relatively decent extent on the call tomorrow morning at 8:30. Excuse me. Jim Bullard, who we talk about quite a bit, one of the many mouthpieces for the U.S. Fed, did give some comments this morning at 8 o'clock. At a high level, I don't think anything he said was necessarily surprising relative to the whole picture. The market reacted very, very strongly on the CPI print. Market rocketed up about 5% when that data came out. Even during the call, we saw futures spike a ton last week when we got the US CPI. But at the same time, it's important to remember that although we have 1 month of data that looks improved, we have not necessarily fixed the problem. There's still quite a bit of a hike to get out of here. We wouldn't necessarily be celebrating inflation print at 7.7% in a normal economic environment. And Jim Bullard recognizes that. He says that Fed rates have had a relatively limited impact on inflation thus far, and says that they need to continue to work to a sufficiently restrictive zone on the Fed funds rate. And what he's saying there is essentially, in Fed talk, there's still work to be done. We've seen inflation come down a little bit. Do we totally take credit for that as a function of the hikes going up? Not necessarily. even the improvement we have seen has been slower than many would have expected, probably the Fed included. And we've got to keep raising rates to get to a point where we see policy be sufficiently restrictive. This is likely a zone of a Fed funds rate somewhere between 5% and 7%, which implies quite a few more hikes potentially, especially as we maybe go towards that 7% number. But he does think that there's reason to think those things can work. He says his cause for optimism is really tied in the fact that the market is pricing in disinflation in 2023. And I think we've seen that. I think, although it was an overreaction with a 5% move in a single day, just on one relatively slightly better CPI print, what the read through there is not necessarily, oh, great, we won, inflation's only 7.7%. What the read through is okay, this is going to work. Has it worked right now? Probably not. But we are probably going to get to a period of disinflation. And so I think he's right on that observation. Honestly, tonally, I totally agree with everything he said. I think it's important for the Fed to share comments like that, to keep market participants, and maybe even more so than market participants, maybe more so just the human factor, to keep everyday Americans informed of what's going on. I think it's very easy to not plug into this stuff every day, not listen to the morning call every day, not read the market memos that we send out on Fridays. It'd be really easy to be like, man, why were stocks up 5%? Oh, the inflation number was good. Cool, it's done. And that's just not the reality. And so I think he's trying to stay in front of that and make sure everybody understands that there's still quite a bit of work to be done. The UK did have a budget announcement, a little bit of a repeat of the age of austerity and a huge emphasis on nuclear energy. The goal here is to lower energy bills, but to try to do so in a manner that's as sustainable as possible. They want to build high wage, high skill economic participants. They want technologies like offshore wind, carbon capture and storage, and above all, nuclear power to really come to the forefront. They expect GDP to be down 1.4% in 2023 and then up 1.3% in 2024. And they expect that their debt to GDP would peak in 2025 or 2026 at around 97%. The defense budget staying relatively lean at 2% of GDP. They're going to cut their foreign aid budget. It'll be about 0.5%. Not going to take it up to the 0.7% that was previously expected. And they say they're only going to increase that foreign aid budget when the fiscal situation allows. So they're trying to take a prudent approach to helping other nations. They really want to prioritize their own nation first. They're going to grow public spending at a rate slower than the economy and stick to the current plans for 2023 and 2024. But after that, really slow down a bit more. In terms of raising revenue, they do think that the decisions announced will lead to substantial tax increases. This extends and increases the windfall tax on oil and gas companies, something to keep in mind if you're watching kind of the energy situation here in the U.S. and the rhetoric shared from the White House. But they're going to increase that tax from 25% to 35%. From 2026 to 2028. So not necessarily an immediate move. They want to get some of this energy infrastructure in place before that happens, but that is certainly going to be a factor in time. Obviously, that's a ways down the road. We'll see how much that sticks. They're going to lower the top tier 45% tax threshold. So they're essentially saying, where's our top tax bracket? Let's bring it down a little bit. So they're bringing that down from 150,000 pounds to 125,000 pounds. And then they're going to tweak the amount of exemptions they allow for capital gains. Currently, you can get about 12,000 pounds and not pay tax on those capital gains. It's going to fall to 6,000. And then in 2024, it's going to fall to 3,000. So interesting approach here, certainly major spending projects, but they're trying to tie that to tax revenue. Specifically tax revenue that they can pick up either from oil and gas companies when they have massive successes, tax revenues from individuals that have high income, and tax revenues that they can generate from folks that have significant amounts of capital gains realized in a given year. interesting environment right now, switching gears dramatically here in the US. Interesting environment as it relates to kind of retail sales. The more we look at this data, the more it starts to seem like Target was an outlier. And I think that's a bit surprising. I mean, this is kind of the second or third quarter in a row in which we've seen Target miss the mark, so to speak. That was a good target shooting pun, but Target seems off target as of late. And so it's been interesting to see that, because we really felt like not that long ago, we felt like Target and their management team and their ability to execute operationally was truly best in class, not only in the retail space, but just at large. I mean, they navigated the COVID pandemic so well. Decisions that they had made on technology and infrastructure investments, supply chains, all of those things really came to the forefront. And a story that seemed like it might take 3 or 4 years to play out for Target got condensed quickly in that COVID environment, and it was executed incredibly well. So they've really kind of fallen, in our opinion, and we're kind of sharpening the pencils and reevaluating. But despite Target, the retail side of the economy has continued to show relatively decent data. When you look at retail sales for the month of October, we saw pretty strong numbers. This excludes auto and gas, but to kind of give you context, in July, this figure of retail sales was up 0.2%. August was 0.9. We saw some slowing in September to 0.6. October up 0.9. So very, very strong there. A good chunk of that came from the grocery stores, which were up 1.4%. But we've seen services hold up pretty well. And we've seen specific companies do pretty well. Home Depot reiterated guidance and said, quote, "And just in case you don't have the numbers in front of you, Chris, you called out monthly cadence. So really our comps were consistent across the months, not just on the 3-year, but also on a 2-year basis." Home Depot saying, "We're sticking to our guidance. You have the monthly trends. We can reread them to you if you want, but we're continuing to look good." TJ Maxx says, "I'm very pleased with our third quarter performance. U.S. comparable store sales exceeded our expectations. Pre-tax margin and merchandise margin and earnings per share were very strong. I'm particularly pleased with the results of our Marmaxx division." We're seeing this commentary that's pretty consistently favorable. Lowe's raised their guidance. Walmart raised their guidance. Macy's even raised their guidance. Amazingly, Bath and Body Works, a company that we kind of laugh about a lot on the call, is up 22% pre-market, and they raised their guidance. A lot of this comes down to inventory and how companies are managing those things, but it's an interesting dynamic, and I'm certainly a bit surprised to see that Target is the company that's lagging here, at least for the moment. It comes down to operational execution, and it seems like there's some under the surface. There's quite obviously some problems here. We did get some earnings from a few tech companies, starting off with Cisco, which we have liked. Primarily as a function, we're hesitant about consumer-facing companies, and we've talked about that. Excuse me, we've talked about that at length on these calls over the last, 6 or 9 months. But although retail has done well, a lot of pockets have done better than we expected. We're still trying to navigate some of the stickier, more recurring revenue, and that revenue tends to be more business-to-business revenue in a lot of cases, especially on the tech side. But Cisco up about 3.5% right now on their earnings report, came in pretty favorable. Another solid quarter for Cisco. There were a few challenges that they faced. Not great data on the public sector orders. Guidance was okay, not great. Gross margin okay, not great. But really, this is more a function, I think, of normalization of the business rather than something that's really dire. Their switching and routing business dramatically outperformed expectations, and that's really the single segment of their business that we look at most closely. As we're kind of reviewing these things, we're pretty consistently seeing increase on all of our internal models that we run based on their data, price increases on our targets. And what that essentially means is story hasn't changed. We can continue to evaluate this company essentially through the same lenses, and given the data that we have most recently, whether it's a function of earnings or guidance and how those things work into there, we feel pretty good that this stock is undervalued. Stock's at $45.85, pretty attractive move today, which is good to see. but really, really executed well. NVIDIA popped a little bit on earnings after hours, but they're now down about 1.4%. Not a great quarter as it relates to earnings. That was not necessarily a shock. It's a complicated story, but we're really paying attention mostly to the chip cycle and where we are on this. Earnings were not great. That was somewhat expected. Interestingly, they have been able to make some changes on some areas of their business that were in distress, specifically in China, that are creating some nice offsets. They made up for an expected $400 million shortfall due to a ban on certain tech sales. But they've been able to kind of weasel their way through that. We've talked about that on the call as well. It's probably been 3 or 4 months since that news first came out. But not a great quarter, but they do seem like they're trying to remain as agile as possible and trying to navigate as much as possible. I will say thematically on the earnings and all the companies we've kind of mentioned this week, on the retail side, I was not surprised to see Walmart perform very favorably. And as I said on the call, I guess it was on Tuesday morning, if Walmart was saying they picked up a lot of business from folks that were making more than $100,000 a year at a household level, we knew those customers were coming from somewhere, and we kind of warned that they're probably coming from the likes of Target. So the retail side, once we do the Walmart data, not necessarily shocking that Target was where it was. I do think the market reaction was a little bit overly pronounced. But on the tech side, certainly not a shock to see that in this environment, Cisco is benefiting more than NVIDIA. And that's not a surprise necessarily to me. I can't speak for Ben or Tom or the other analysts and PMs here, but not a shock there. And I think portfolio positioning for the most part kind of reflects that. That's hyper short term. We're not buying stocks simply for the quarterly report, but it does seem like we're starting to see some real nuance as it relates to actual performance and as it relates to actual execution. Target getting beat up for not executing, Cisco getting rewarded for having relatively decent performance. NVIDIA not getting punished too much on the earnings side because they're solving a bigger problem as it relates to the sales to China issue. So an interesting dynamic. I think the market's being really discerning right now, which I think is favorable. We do, again, have futures down, so it'll be something we've got to continue to kind of keep an eye on and monitor. But we'll be back tomorrow morning, and we'll have a good recap of what Christine Lagarde said and other major topics. Hope you guys have a great day. We'll talk to you soon.